Welcome back to part 2 of our interview with Stephanie Link. This week, we're going to get into investor mindsets, time frames, ways to get our heads right to become more successful investors. Stay tuned. Well, week 2 for everyone else. Quick 5 to 10 minute break for us. Let's get into investor mindsets. I think, certainly this is not my original thought. Behavioral finance might be as important as anything when it comes to being a successful investor. And so much of how we think about markets, it turns out to be very counterintuitive in terms of how they actually operate. So I'd love to pick your brain. We're going to touch, for those of you, on 4 big things. Again, this week might run a little bit longer than your typical week. Time frames, how you think about time frames, how markets work, particularly around absolutes, which is how most of us go through our lives. Is it good or is it bad versus relative expectations? Closet market timing. No one wants to own up to being market timers, but yet they often do it. And then just some helpful takeaways. So when it comes to time frames, one of the things we try to remind you all the time is that half of trading days are negative, approximately, about a third of months, and about a quarter of years. And so we know, that everyone's always judging things from the peak best valuation they ever had in their time. And if it's not that, they assume something's not working. It's only over time that we obviously see that things have been working. So how do you think about time frames? How do you make judgments on your own investment decisions? Because I think that's, again, a lot of times people are like, well, do you like it? Well, do I like it for the next week, the next year, the next 5 years? That part rarely gets discussed.
I know, and it is important to think long term. I think of it in two buckets. One are the secular growers based on the themes that I like in the market. Those stocks will ebb and flow in the market, right? And I want to stay patient with them because I have like 5 themes and I feel really strongly about those 5 themes. Mm-hmm. So housing, cybersecurity, animal health, onshoring, as we just talked about, mm-hmm. and healthcare. Mm-hmm. All of those, and within healthcare, that's kind of big. Animal health is a big one. Insurance, managed care is a big one. Weight loss drugs, a big one. Mm-hmm. So there's so many themes that I start with, and if those stocks under those themes fall hard, I want to buy them on days like today, and I want to just keep accumulating because I feel very strongly that over the next decade those themes will work. On the other side, there may be a few opportunities, shorter term opportunities. There's a name that I bought in the summertime, that I bought in cybersecurity. It had fallen 41% on a glitch that happened around the world, and I took advantage of that. But it was always an expensive stock for me to own, and so it rallied 95% from that low. And then I just took some profits because 95% is a lot in a 6-month period of time. Yeah. Love the theme, but there are other players that I would rather own that maybe are a little less expensive and I can get my hands around. So there's a couple like shorter term ideas that I might trade around, but for the most part, I really do try to think longer term. That's why I think thematic, for me anyway, thematic investing is so incredibly important.
Yeah. No, we talk about themes and thematic consistency all the time here, but to paraphrase then, because I think a lot of times the investor, and I put out a small video a couple weeks ago of the market doesn't care about your goals, doesn't care about your time frames, doesn't care what you call your portfolio. It's going to do what it's going to do. But if I'm hearing you correctly, you've got your themes, you want to see those themes play out, valuation plays a role. It isn't to you about, I plan on this happening in the next X amount of months or X amount of years. That's not necessarily part of your process. Do I have that right?
Yeah, that's right.
You're not buying something that you plan on being successful 20 years from now, but
no, you're right.
You're not judging yourself based off some type of an arbitrary time frame.
I get mark to market every day, so I do pay attention to it. Mm-hmm. I do see, obviously every year we have our returns, and I want to make sure I'm delivering value-added service to you advisors, your clients. So it's very important to me. But I just think it makes sense to try to give a little bit of patience around investing. Sometimes things work, and sometimes certain sectors work. Sometimes at the same time, certain sectors don't work. So but that's the whole point of like diversifying, because you don't want everything to work at the same time, because then when it doesn't work, everything's not going to work at the same time, and then you're going to get hit. So it's diversification. I try to keep a longer term perspective, not too long. The themes are what keep me grounded. Mm-hmm. And I may, by the way, sell one of the names under the theme and buy another one in that theme, right? So so that's why I think it's kind of it's interesting to think it through this way, but I think it's a little bit more of a two-prong approach.
No, we agree, and I think again, there's no perfect way to try to invest, but rather than getting frustrated because something isn't manifesting and judging it based on something that it doesn't care about, the stock, the market, whatever, again, judging is the theme intact? Yeah. Is that likely to play out, and giving things a little bit more time than you might otherwise? When it comes to how markets work, particularly as we sit here today, sentiment, it'll be interesting to see some of the more recent studies, but recently, AAII, near, probably below now October of 22 lows. The CNN Fear and Greed Index, when I checked in, it's down in the low teens. You can go on and on and on, but it's bleak. People are, and one of the things that we try to remind our clients, I would love to hear your thoughts and have you speak to it, is the phenomenon that less bad can actually become a better investment than something that's less good. And just the role of investor expectations in terms of what may lie ahead for a stock or the market.
And that's a perfect way of putting it, though. It's like, it's sentiment. Right. It's when everybody's on the same side of the boat, right, it better be perfect. Yeah. Performance better be perfect at these companies. And any little incremental change to perfect will really hurt the stock. Right. On the other hand, and I don't want to be all the way by myself on the other side of the boat, I want to be somewhere in the middle.
You need someone to agree with you.
Someone or so. That's when it's clear that something is wrong and people know it. That's why nobody owns it, right? Mm-hmm. So then if something incrementally gets a little bit better, when everybody thinks it's so terrible, that's when you can make a lot of money and quickly. And I'll tell you, I've made the most money, I mean, in probably my career, in some of the beaten down industrial companies that have a change to management. Mm-hmm. So I think I can mention some names, but I'm not going to do that. I won't put you under that stress from compliance. Yeah. But I think that things were so bad and there are probably about six or seven companies in the industrial space that, and in technology too. Things were so bad, things look so bleak, nobody owned them. You get a new leader that comes in, takes a while to change, a quarter or two, and then all of a sudden things start to get less bad, and the stock and the bears keep fighting it and fighting it and fighting it. And yes, you can make a lot of money. A
lot of capitulation. I was reading today about a strategy that again will remain nameless, but they go by things that have fallen out of indexes. I think a lot of times, again, we've joked like the S&P 500 did not come down on the tablets to Moses, right? Like it is a man-made, selected thing, but someone did, I think it was a 40-year look back. Mm. And they found that a lot of the stocks that got pitched out of the indices had actually outperformed the indices subsequently.
That's very funny.
I thought that was interesting.
It is.
Let's talk about closet market timing. Nobody will own up to being a market timer. Speaking more of, again, just kind of the average investment mindset or maybe what people might read. But you'll hear things like, don't you think we should get out before it keeps falling further? Well, that presupposes it's going to fall further. Mm-hmm. Or I'll get back in when I've got more clarity and things feel better. Why does that not work?
Well, it could work if you time it perfectly, and if you get back in perfectly, and it could work if you get back in and it's not perfect, but you're not going to make as much money. Right. So it's impossible to market time. I mean, I had amazing advice when I was right out of college from my father when I got my first job. And he said, okay, you're 22 years old, you should start investing. And I said, I don't really know what to do. And he said, here's what I would do. I would buy an ETF, a Vanguard or an S&P 500 ETF, low cost, and dollar cost average. And even if it's like $25 a month, just have them take it directly from your checking account or your savings account and put it in every month, and see, over time you'll see that you can't time the market. You're gonna sometimes you're gonna buy low, sometimes you're gonna buy high, but the average will be what it is, and that presumably will be lower than a year from now, 2 years from now, 5 years from now. It was great advice. I do that with my portfolio. I dollar cost average all the time because I can't time it. Nobody can time it. But the problem is you just have to stay patient. You absolutely have to set goals. Like if you are going to stick by this, you're going to have to know that the market is going to fall at times, and you have to be adding a little bit if it does, and maybe you just trim if it rallies in a pretty big way. But it's really hard. As I said in our last clip, I mean, people say they buy low and sell high. They really don't.
Yeah. One of the things I see is how your good call, if you're right, and things do progress upwards or downwards, whatever the case may be, is it gets very hard to ever change, to eventually sell high or buy low, because if you get out and it drops, all you're getting is positive feedback. Oh, I'm so glad I did that, so glad I did. It's very hard to reverse that kind of, again, positive sentiment. Glad I stayed in, glad I got out, whatever. And then do the hard thing, which is to switch.
To switch back, that's
and
right.
When something's feeling good, to get in.
That's right.
And then you see it go up. Oh, okay, well, I should have done it. I'll wait for it to come back. And it just very well may not.
I think you got to think about it. The long-term average in the S&P 500 is 7.7%. So the last 2 years, we've seen the market grow 23% last year, 26% the year before. That's not normal. Even though we felt really, really good, it's not normal. 7.7%. This year is mean reversion year.
Right.
And it's mean reversion year because we have the tariffs, because we have the slowdown. It is not the end of the world by any means. I think in the second half of the year, once we get through tariffs and we get to some of the other initiatives from the Trump administration and their goals, I think we could see growth stabilize. We get one little sniff of growth stabilizing, the market's going to go a lot higher.
If we're going to leave people with one takeaway, it feels like the takeaway we should leave them with is how the heck to approach volatility. When the storm is raging, what should they be doing, thinking, feeling? Well, maybe not feeling, they're going to feel bad, but what should they be doing and thinking?
Yeah. Well, I think the first thing I would say, turn the TV off. I mean, I want
This is as a person who's on TV.
I want you to watch me, but I don't want you to be
Once you're
feeling
done,
really bad.
click it.
You
All
just
right.
have to recognize that negativity sells more than positivity. And so on the bad days, it's going to feel even worse because the words that you were saying, crash, crumble, dire, plummet. I mean, that's the thing. Those are the things you're going to hear. Outside of that, I would say, let the professionals actually deal with the volatility. That's what you're so great at. That's why you diversify them so much, because, by the way, equities might do poorly, but fixed income is doing great.
Right.
Let this wonderful team at 10 Cap do their thing, and I use volatility not as, I just don't think it's something to be scared about. I think it should be something that you look for opportunities. When I see a lot of volatility like we're seeing, I always try to upgrade my portfolio. The number one or number two player in any given industry, that's on sale.
Right.
Like, you don't need to own the number 3 or 4 or 5 company in this environment, because you're getting number one down 25, 30%, whatever the number is. And chances are, if they're number one in the industry, they have the number one management team in the industry, and they will figure it out.
Yeah, all right. Well, thank you, as always. Thank you for sticking with us here, and we'll see you soon.